Well, thank you all for joining us. We're really excited to be with you today. We're grateful that you made time on a Thursday night to get online, get on Zoom. I think everyone's zoomed out, but this will be thrilling and enjoyable for everyone, I'm sure. My name is Sam Tenney. I am the owner and founder of Fidelis Wealth Advisors. We have Lori Jones, my business partner on, and Jeff Bullock, our chief investment officer. And so we are glad you're all joining us today. We understand that we live in times that are very interesting, and people are looking for folks that they trust to give them advice and to interpret all the noise that's out there. And we hope to help with that tonight. Jeff will do a lot of the speaking. Jeff has been with JP Morgan for 10 years and has been with us almost a year, and is a very, very sharp, smart guy, as you'll find out soon. I want to do, for those of you that don't know who we are, Fidelis Wealth Advisors. Fidelis means loyal and faithful. We really do care about our clients and being loyal and faithful to them. There are buzzwords in our industry like fiduciary and putting our clients' interests first. This is my sales pitch, and what you get from us is transparency and honesty. We care about agendas, and everybody has an agenda, every organization. Every financial company, every financial product is created with an agenda. And it can be a dual agenda, what's best for clients, but also what's best for that company. Our agenda, in the end, is to understand what your agenda is and remove conflicts of interest as much as possible on our end. And we do that through not having proprietary products, using Schwab and Fidelity as our custodians, and really trying to give the best advice we can by aligning your will, your agenda with our agenda. And that's really who we are. And we do that in how we give advice, and we know we're good at it. I want to introduce the team. You can see in this picture, there's Lori Jones. 4.5 years ago, Lori and I met in the Neaters in Highlands Ranch, and Fidelis was born. We started with cardboard tables, and we are in our new office in downtown Castle Rock, and we hope you all join us April 8th for our open house. It's a beautiful office, and we love coming to work every day because we love our job, and we have a nice office. Jeff, as I mentioned, is our chief investment officer. He will speak a lot tonight, and we're grateful to have him on board. And then we have Don and Sky, who some of you have probably spoken with and have helped you with paperwork. And Lori runs the office and takes care of everything, and Don and Sky help her. And we also have 2 interns that work for us. So we're growing and doing well, and grateful to be in this business and grateful you spent this time with us. I am going to let Jeff speak, but before I do, we want this to be interactive. So you should see a poll that came on your screen, and who's going to win the Super Bowl on Sunday. So we will calculate everybody's results. We got 2, 4. We have a I don't care, let's talk money. All right, so we still have 6 people left. Let's see if some might be on the online only or phone only. So 3 more. Okay, you ready to see the results? There's 2 left. I'll give you another couple seconds. Here they are. So 6 for the Bengals, 4 for the Rams, and 2 for the halftime show, and 2 who don't care. So there you go. Oh, did you see that? Okay, sorry, I didn't share you. You see the results now. All right. So I'm going to turn it over to Jeff, and he's going to start with a quick poll too. Do you want me to run that, Jeff?
Let me unmute. All right, can everyone see me and hear me? All right, great. It's great to be with you tonight. So tonight we're going to run through a few sections. We'll talk about the economy, we'll talk about markets, we'll talk about investments, and then want to make it interactive. If you have questions, I'll pause kind of at different points during the presentation and ask for questions if you have some, and we can do any Q&A at the end. So let's just do a quick poll to get a sense of the room. Sam, if you don't mind throwing that first question up. So how do you feel about the economy right now? Just simple question, right? We're feeling great, we're feeling good, we're feeling okay, feeling nervous, don't really know and here to learn. Wait a few more responses. We'll give it one more. All right, let's publish those, Sam. So a few goods, a few okays, a lot of I'm nervouses. All right, that's good to know. No one's feeling great about the economy. All right, that's good to know. Good to know how we're feeling. So I'm just going to give you a little overview of what I'm seeing, what we're seeing, and then we'll go from there. So let's just start with corporate profits. Let's start with how are businesses doing right now. This chart right here to the left, corporations are doing well. You can see this bar chart shows corporate profits going back to the 80s. Green bar represents a recessionary time. Gray bar represents a growth time. So, as we know, there's business cycles, ups and downs. We're coming off of one of the quickest recessions in US history in 2020 due to the COVID pandemic, and had a really strong bounce back year in 2021. And most analysts are forecasting pretty good results for the next few years. Corporations are flush with cash, they're making money, and they're growing. We are currently, if you were to say, where are we in the business cycle? We're probably mid-cycle. We're past the initial peak, but we're still growing. Businesses are still growing, profits are strong, and earnings are up. And so that's more or less the state of where corporations are. If you look at GDP, which is gross domestic product, this is more or less how do we measure the growth in the economy as a whole. You can see going back to 2000, the US has grown roughly, the gray bar represents the actual growth and the dotted blue line is sort of trend growth. If we were to grow at 2% every year, what would it look like? And more or less the US has grown at a 2% rate every year for the last 20 years. Obviously there was a big dip during COVID, but it's bounced back sharply and we're almost back to what would be considered trend growth. Most of GDP, if you look on the right side, I don't know if you can see my mouse when I'm twirling it or not. Most of GDP consists of consumption, which is just very much you and me spending money. So when consumption is high, GDP is usually positive. So I highlight that because the next slide shows an interesting part of the economy where consumption is still down. So this is consumption data for hotel, restaurants, and travel. So hotels in green, restaurants in purple, and travels in blue. And you can see pre-pandemic, if you kind of start everything at zero, those three industries dropped off dramatically. And fast forward 2 years, they have not fully recovered to pre-pandemic spending. They were close, but then when the recent Omicron variant hit, the spending in those areas dropped off, and restaurants are still off 25 to 30% from where they were even pre-pandemic. So this actually gives me a little bit of, I actually think there's a little bit of tailwinds that could come in the economy because of this. If we do get a scenario where we open up more and people start traveling and spending, this is where I think a lot of the discretionary spending is going to come from this year. Let's talk about the consumer. So the average individual and family is actually on very strong footing. In this top right graph, you can see household debt is near its lowest it's been in 40 years. And in the bottom right, household net worth is the highest it's ever been. So again, we're talking about the average individual, the average family is better off today in theory than they were a few years ago, and in a better place from a debt and a net worth standpoint. So, going back, corporations seem to be in solid footing. The economy is growing, albeit slower than it was last year. It's still growing, and the consumer seems to be in a decent spot. I like this. This is the labor market. At the end of last year, there were 11 million jobs available. The quits rate was at all-time highs, people quitting right and left to find new jobs, and the layoffs rate was at all-time lows. Basically, the best way to sum it up is if you needed a job, you should, and if you need a job now, in theory, you should be able to find one. It's a very tight labor market, which just means a lot of jobs out there for those who are seeking. So now let's talk about the big elephant in the room, right? Inflation. That's what we're hearing about and talking about. So the blue line represents core headline inflation. At the end of November last year, we printed our highest number in almost 40 years at 6.9% year over year inflation. If any of you are watching the news this morning, I did a little clip art on my next slide so you can see, but this morning we printed a 7.5% number, coming in at the highest inflation rate since 1982. You're feeling it, I'm feeling it, we're all feeling it, we can see it, and it's very real. The reality is it's probably higher than 7.5% because the way they calculated inflation back in the day is different than they do now. And if you would use that same formula today, it would be much higher. So inflation's our big elephant in the room right now. And so that leads us to the next step, the Fed, the Federal Reserve. So our central bank, this is a graph of them controlling interest rates for the last 20 years. You can see in 2016, they started raising rates again, but once the pandemic hit, they dropped them to zero. So really for the last decade, we've been in a zero interest rate environment. What I want to highlight is right here, kind of this blue dotted line going up. At the end of December, the Fed came out and they put forth guidance and they said, we're going to raise rates. We need to raise rates because inflation's hitting us. And this is the path that we're going to do it on. And the market digested that. And the market basically said, okay, we can handle that. And you actually saw the stock market rally into year end. It was kind of your classic Santa Claus rally for the last 2 weeks of the year. And then January hit. And obviously, if you've been paying attention to markets, we've had a rocky start to the year. And the reason why is because as inflation prints have come in higher than everyone expected, the Fed's gotten more aggressive and has said that they're probably going to raise rates at a quicker pace. So excuse my clip art again, but more or less, this is what happened. You went from, in about 40 days, you went from this blue line being the projected curve, which basically implies 3 to 4 interest rate hikes this year, to now the consensus is 5 to 6 interest rate hikes this year. And that more or less just throws a wrench in the whole market because growth companies are now going to have to pay for higher debt. And you just have more headwinds towards growth with higher interest rates, especially moving that quickly, looking to raise interest rates that quickly. So the Fed got us into this situation. How did they get us into this situation? They printed money. So this is the Fed's balance sheet. It really all started back in the great financial crisis and the housing crisis in 2008. When they went in to shore up the banks and shore up the housing market, they printed $1.5 trillion to buy bonds and mortgage-backed securities and treasuries. And what happened, though, is they didn't stop buying. As you can see, they did the initial purchase 2008, 2009, and then they just kept buying. And their balance sheet exploded from $500 billion to $4 trillion before they decided, oh, maybe this is too much and we need to taper it off and not buy as much. And they did that for 1.5 years, and then the pandemic hit. And then they doubled their balance sheet in 1.5 years, printing another $4 trillion. So if you're asking where did inflation come from, this is it. They printed $9 trillion in the last 13 years that has finally trickled into the economy.
And I would also add that in addition to that, what Congress and the last two presidents have done has approved, $7 trillion of money that has gone into the economy, and it was, you know, almost 7 times what they did back in 2008. So those are stimulus checks. Those are giving child credits, things like that, and so all that, those two things combined cause where we're at right now.
So we're very much, I mean, to use the cliche, we're stuck between a rock and a hard spot. There's no easy way out of where we're at. The Fed can raise interest rates quickly to temper inflation, which is probably the right thing to do, but you're going to slow the economy down. And if they do it too fast, you're going to risk throwing the economy into a recession. Or they don't do anything and inflation runs hot, which I think most people would agree that's a worse of the two outcomes. So they've indicated they're going to do two things I have here on the right. They're going to taper asset purchases, which basically means they're going to stop printing money. And then they're going to raise interest rates. And they're hoping that those two things solve the problem. The third thing that they can start doing is reducing their balance sheet. So actually selling bonds or letting them roll off and not buying more. That's the big question mark of if they're going to do that or not. I think their path forward is they're going to stop printing and raise interest rates and see if inflation can come down. So I'm going to pause there. That's the quick overview of how we see the world and the economy. I would generally say, if I was to answer the poll question, I feel good about the economy. Corporations are in a good spot. The consumer's in a good spot. I just don't feel good about inflation. That's the big elephant in the room that's not helping any of our causes. And so how the Fed deals with inflation is very much going to be the path of what happens this year and next year in markets. So I'm going to pause there. I've got moving on to kind of market sentiment next, but if there's any questions around the economy, or we can wait till the end, I'll pause there and see if anyone has any questions. You can unmute yourself and ask a question.
Or Laurie, do you have any chat questions?
Yeah, if you want to go ahead and put those questions in chat, I can bring them up and when Jeff asks for questions. So if you've got anything that you're thinking of while he's talking, just go ahead and put that in chat.
I would just add one thought to what Jeff said about the inflation. If we're having 7.5% inflation, and you're only getting a 3 to 4% raise at work, obviously you're not keeping up, and so that's going to be an issue. And although people have a lot of money, or they have more money in the bank or in savings, which is great, and their house is worth a lot, it could flip pretty quick from households being in good shape to they're in way too much debt, and that will fuel the economy for a while. That would be a tailwind, but that would be a more negative thing down the road, because our government already has enough debt and corporations have enough debt. So the consumer gets too much, that would be bad. And it will cool off the housing market if interest rates go up too high, as the Fed is starting to raise rates. So those are all issues that we're watching.
Hey, Jeff, we do have a question.
Yep.
Someone asks, are you seeing people pulling money out of the stock market, more in, or stable?
That's a great question. I'll address markets in my next session. At my high level answer is it's stable to adding. I mean, everyone's in a different situation. So those who are sitting on cash, I'm seeing them add into the market, especially since we've recently had about a 10% pullback in markets. But it's hard because there's nowhere to go. There's nowhere to hide. You pull money out and sit in cash, you're guaranteeing yourself a 5 to 7% loss on your value if you want to do that. And so I'll address that more in my next session when we get to kind of risks. All right, so how does this impact fixed income and equity markets? So let's talk about the fixed income market. Here we've got a chart of the 10-year treasury yield. So a good proxy for what yield you would be able to get if you're investing in bonds and fixed income. So the blue line represents the actual nominal yield that you would get, but the gray line represents what you would get after you account for inflation. So the sad thing is the conclusion, what you can see is the last decade has been a really difficult time to be a bond investor. You've made money on a nominal basis. If you look at the blue bar, you made 2, 3, 4% annually. And so your account might be bigger, but on a real basis, accounting for inflation, you're flat to down. At the end of last year, inflation was, if you adjusted inflation compared to the 10-year treasury, you locked in a negative 3.5% yield. So that's how much it's eating into the bond market. The bond market's tough sledding right now is the best way I can describe it, especially if we're going into a rising interest rate regime. There's a lot going on this page. I really just wanted to point out the bottom right chart right here. And what this chart shows is the average duration, or in other words, the average maturity of a bond dating back to the 80s of an investment grade bond. What you can see, and all you really have to take away, is it continues to trend up. And all that means is that to get the same return in the bond complex, you have to take more risk nowadays, because you have to take a longer duration bond to get a similar return that you could have gotten 5, 10, 15, 20 years ago. And that's just sort of, again, the nature of what's happening, the big picture in the bond market. As yields go down and continue to stay low, investors are extending their duration risk to try and get some sort of return, but now you're going to be much more interest rate sensitive. So in theory, the bond complex is slightly more risky than it was 10, 20 years ago because of duration risk. Going to the equity markets, here's a great chart of what the S&P 500 has done dating back to the mid-90s. We've lived through a few different boom and bust cycles of the 90s, the tech bubble, then the early 2000 boom up to the financial and housing crisis. And then we had one of the longest bull markets in US history, from the end of the housing crisis until the pre-COVID drop. And as you can see, what the market did in kind of the COVID era with the sharp drop, but the real quick snapback. The big thing I kind of take away from here, and which I'll talk more about, is if we're investing in equity markets, volatility is a normal part of the experience. And quite frankly, I would argue and say that volatility is the price you pay to get returns. If you were the worst timer in history, maybe not in history, but in recent history, and you invested on March 24th, 2000, right at the peak of the tech bubble, and if you were disciplined enough to just hold, you held through the tech bubble, through the next boom, through the housing crisis, and then to where we are today, you still would have tripled your money. It was rocky. It didn't feel good along the way. But if you bought and hold for those 20 years, you tripled your money, which would have been roughly a 7 to 8% annual return, which is what the stock market gives you. And so again, I just illustrate that even from a timing perspective, if you had bad timing and you dump money in at quote unquote the worst time, time is your friend in investing, and we'll get more into that. A lot going on this page, but I wanted to highlight this top right graph right here, and it's talking about the concentration of the S&P 500. So the S&P 500 is made up of 500 stocks, but right now the top 10 stocks make up 30% of the size of the market. Your biggest companies right now in the world, the Facebooks, the Apples, the Amazons, the Netflixes, the Microsofts, you combine those together and the top 10 make up 30% of the stock market. And all it means is, even if you're an index investor or a passive investor, index investing today is very different than it was 10 years ago because of how concentrated the highest stocks are. It's not good, it's not bad, it's just more, it is what it is. And it's just good to note when we're building portfolios, we take this into account. Kind of last thing I'll say on the equity side is I get a lot of questions about, should we invest in the US versus international? It's a great chart that shows where was the best place to invest over time. Purple represents years when it was better to invest abroad. The gray represents years when it was better to invest in the US. You can see since the financial crisis, we're going on 14 years of the US being the best place to invest your money. One of the longest stretches in recent history. If you've invested abroad, it doesn't mean you didn't make money. It just means you didn't make as much than if you were in the US markets. The big question that all of us investors are trying to figure out is, at what point does this flip? People have been calling for the flip for the last 5 to 7 years, and the US has continued to be the strongest horse in the race. So again, interesting anecdote, something that we take into account when we're building portfolios. And the last thing I'll say on this side, on kind of with markets, is yield. Always get questions about income and yield. How do we get yield in a zero interest rate environment? The answer is it's hard, right? As I mentioned, the bond complex is just hard. It's very difficult to get any type of return, let alone a return above inflation in the bond complex. If you invest in equities, you're going to get dividends, and dividends can range anywhere from kind of 1.5% to 3%, depending on where you're investing. And then there's higher risk bonds or preferred securities that can get you a higher yield. My punchline here is that higher yielding instruments come with higher volatility. So if you ever come across someone who's offering you, hey, I can get you 7, 8, 9, 10% yields. Yeah, they exist, but you're going to be stepping out on the risk spectrum pretty far. That doesn't mean they're not worth looking at, but I always just cringe when someone comes to me and says, oh, I can get 8% risk-free. Like someone was pitching it to me. Like that doesn't exist, right? There's a direct correlation between the yield you can get and the risk you're taking to get that yield. And we just take this into account when we're building portfolios, because when we're trying to balance growth versus income versus volatility, it all goes into trying to craft a portfolio for you.
Jeff, I'm going to launch the investment question poll. Okay, so here's a new question. How do you feel about your investments going forward? All right, we got about 70% of answered. Wait another few seconds.
Good.
All right, so let me share the results. Go ahead, Jeff. You can interpret that.
Yeah, good. Hey, I feel good too.
Great.
As we'll get to, time's your friend in investing, and we'll talk a little bit more about that. I feel good about investing. I feel great about certain areas of the markets too. I feel okay about other parts, like the bond complex. Obviously, I've hit on that. I've beat that dead horse to the ground, but I'm glad we're feeling good. All right, so how does this impact my money? I mean, isn't that why we're all here, right? It's great to learn about markets. It's great to learn about the economy, but at the end of the day, how does this impact my money? When it comes to investing, there's 2 risks that we deal with, and that, I mean, my job is basically to balance these 2 things. You have volatility risk and you have inflation risk. Volatility risk is just simply that you invest in something and it can go up or it can go down. Your price will fluctuate. And if you don't like that idea of it fluctuating, cash, CDs, and money markets are your place to be, because those have stable values and you're not going to have to deal with the ups and the downs in the market. The problem is if you don't take any volatility risk, you're taking inflation risk, or the risk that your purchasing power, the value of your dollars, are just degrading over time, because we live in a monetary system where inflation is not only prevalent, but it's encouraged. The Federal Reserve purposely tries to have 2 to 2.5% inflation every single year. That's their stated goal. And so by taking no risk, we're already losing out of the gate. So assets that have historically addressed this risk are equities, sometimes fixed income, real estate, commodities. And the big dilemma, right, the big paradox of investing is that you can't get rid of both of them. Yet you have to take on one or the other. And the reality is when we build portfolios, we're basically just managing one or the other. I would say, though, that 95% of my conversations all center around volatility risk. And I could make a strong argument that inflation risk is the riskier risk out there. So I really just want to hit on both of them real quick. This is a great chart of the stock market returns going back to 1980. The gray bar represents what the market returned in that year, and the red dot represents the intra-year pullback or the volatility of the market in that year. So for example, in 1997, this looks like the market was up 31%, but there was a time where you had an 11% pullback in that year. Or during the crash of 87, we always talk about the crash of 87, but the market was actually positive that year, right? And so you can see now there's always a reason not to invest. And I put a few headlines on the right to see. And if we were to pay attention to every single headline and every single bad news bear out there, we would never invest. But the reality is if you believe in human innovation, human ingenuity, and that companies are going to grow, the stock market's how you participate in that growth. As I mentioned before, volatility is the price we pay for excess returns. On the inflation side, and this is where I could argue.
Go back real quick, Jeff. I just want to point out, because on that slide, on that previous slide, it says the average intra-year drop is 14%.
Correct.
And what did we go down already in January, basically?
We only hit 11% in the S&P 500. So if we didn't like January, we haven't even hit an average year.
Right.
So inflation risk. Here's a great chart, similar idea. If you invested $100,000 in a savings account, just in your bank, so you're not gonna take any volatility risk, what you would have earned. The blue lines represent every year what you needed to have earned to have beaten inflation. And the sad thing is that if you've had any cash for the last 13 years, outside of what you need just to live your life, you have lost to inflation every single year. And so we always talk about currencies, right? We always talk, well, what are the three things that make up a currency, right? It's a medium of exchange, it's a unit of account, and it's a store of value. And unfortunately, since 2008, cash has been a really poor store of value if you're trying to maintain your value. And because we're in this low interest rate environment, all it really means is we have to step out on the volatility curve to get returns to at least meet, let alone beat inflation. So I'm going to hit this slide. This is like the money slide. This is my favorite slide of everything that I hit every time I talk with my clients or folks who want to talk with me. With investing, time is your friend. So here's the green bar represents stocks, blue bar represents bonds, and the gray bar is a 50-50 split. And this is your potential return if you invest for 1 year, 5, 10, and 20 years. And all I really say is in any one given year, anything can happen. We could be up big, we could be down big, we could time it wrong, we could time it great, or we could make no money. But once you're invested for 5, 10, 20 plus years, the chances of you making money is really high because that just gives you time to work through an economic cycle, work through businesses growing their business and participating in that. So we manage money at Fidelis for the long run. I know that's cliche to say, but when I'm positioning portfolios, that's how we do it. We had a 2% off day today in the market. Doesn't feel good today, but I'm sitting there going, great. Stocks are on sale for 2% today. We can buy more because we're doing it with 5 and 10 year views for our clients' money. Time's your friend, and we always just have to have this perspective when we're investing. So I'll pause there. Lori, are there any questions, or does anyone want to unmute and ask a question?
Yeah, there's a question on asking if you'll weigh in on Bitcoin investment this evening and risk. Considering it's likely close to Fed regulation, what will that do to the risk return?
Yeah, I love talking about cryptocurrencies and Bitcoin specifically.
One knew that.
Yeah, we could talk for an hour about this. So Bitcoin, cryptocurrency, an emerging asset class. Where to start? I don't even know where to start. It's an emerging asset class of digital assets that is getting a lot of attention lately, mainly because of the volatility and the price movement. We should probably do a lecture or a webinar just on cryptocurrencies. Honestly, answering it in 30 to 45 seconds is almost impossible. But whoever asked that question, hit me up offline and I'll gladly have a long conversation with you. All right, I'm going to kick this over to Sam.
All right. So I'm just going to go through 2 or 3 slides and then we're going to wrap it up. But most people that we're working with, we found that most of our clients care about not outliving their money. And so they put, this small responsibility on us to make sure they don't outlive their money, because, we're crazy and we want to be in the business of taking that responsibility on. Anyway, this slide talks about if you're 65 years old and you're married, you can see at age 90, there's basically a 50% chance one of you is going to live to age 90 and a 20% chance that one of you is going to live to 95. So how do we plan for the future? And that's where it comes down to, we have to take some risk, as Jeff mentioned, so that we make sure that you outpace inflation and you don't outlive your money. Go ahead. This chart is one that's kind of busy, but it talks about, time is your friend, and consistently investing and keeping your money invested. You have Nervous Noah who put all his money in cash and earned a 1% return. You have Quitter Quincy, who started young. We met with a 15-year-old today, just so you know, and excited to see him save money, because he's starting, actually 16 years old, but starting 10 years before Quitter Quincy. You can see in Quitter Quincy invested $24,000, $200 a month for 10 years. And he has more money than Nervous Noah, who invested $96,000, $200 a month for all those years. So, and late Lila, she waited that extra 10 years and she ended up with almost the same amount as Quitter Quincy, and had to put in 3 times as much to get there. So consistent Chloe in this scenario had the most money. That's time's your friend, be patient, and work on managing risk. That's the moral of the story here. And as Jeff mentioned, this slide is important for trying not to time the market and stay invested. You look at the last 20 years, if you stayed invested the whole time, like he said, it showed the chart earlier, you would have been up about 7.5% per year. But if you just missed the 7 best days, your rate of return would be cut more than in half. And 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So trying to get in and get out is pretty dangerous. So best advice, let's make sure we figure out the right risk spectrum for you and make sure that we have you in the right place, and then stay invested through the bad times. And what I can say is I've been doing this 22 years this year, and I started in 2000 through 2010, and it was painful that first 10 years, having the market go up and down 50% twice. I know how a market collapse like that can keep you up at night and can change your behaviors, change whether you work or when you retire. Those are real things, so that we have empathy for that. So Jeff is the fundamental investor, and I'm a little bit more of the, okay, let's figure out for you, how are you going to stay invested through all this and still be able to sleep at night even when bad times happen. So we're a good mix there. The last slide I have here is, if you're going to start saving for the future, you start at 1 at the bottom. This is kind of a really good basic slide that talks about where should you go next. Make sure you have 3 to 6 months savings for emergencies. Then, the HSA, especially if your company matches and you're eligible for one, is a great place because it has triple tax benefits. Saving in your retirement account and getting the free money from the company, paying down high interest credit cards. And you can see as you go up the list, that's we follow that pretty closely. You know, you can adapt it to your situation a little bit, but that's a very smart way to look at it. And I'd be upset with myself if I didn't say this. One of the best things we can do for you has nothing to do with investments. It has to do with your behavior. If you are not currently financially independent, meaning you can retire or do whatever you want, the best thing you can do, even before hiring us or working with us, would be to save out of your own pocket and make it automated and out of sight, out of mind. And if you're already doing that, increasing it just a little bit every time you get a raise, every few months, you know, that will, you know, fertilize and water your money tree better than anything else, better than anything we can do with your investments. And we're pretty amazing, but that's, you control that. So go ahead, Jeff.
Yeah, we'll just hit some final thoughts, and then we'll do one last poll question. So I get a lot of people going back to markets. What's my outlook? Am I thinking things are good, things are bad? So I'll kind of give you my base case, bull case, and bear case scenario. So what I think is going to happen, my crystal ball, which, you know, not worth a lot, but based on everything that we're seeing, I think it's going to be a good year. It's going to be an okay to good year in markets. If we get 5 to 6 rate hikes from the Fed, the market's currently expecting that. That is priced in. If the economy continues to open up post-COVID, if we get travel, discretionary spending picking up, that's good. That's great. Equities will probably grow, earnings will grow, corporations will make money. Multiples will probably contract a little bit, but I'm guessing we'll eke out a positive return this year. Fixed income's gonna be tough sledding. I've dogged on it enough, but you know, credit's gonna be stable. But if rates are rising, it's gonna be flat to slightly down. It's just gonna be a tough year in the fixed income markets this year, and we sort of just have to accept that. So that's good. My base case is positive. The bull case is obviously really positive. If the Fed surprises with fewer interest rate hikes because inflation tempers on its own, then the market's going to rip. But the caveat is because inflation tempers on its own. If the Fed surprises with fewer rates because they think the economy's weak, that's not great. But if inflation tempers, fewer interest rate hikes, consumer spending is going to go up, earnings are going to grow, and multiples probably don't contract, and you're going to see pretty solid positive returns this year, probably high single digits. You might actually eke out a return in fixed income if something like this happens. So that's positive. The bear case, obviously, is inflation runs hot. The Fed's got to raise 6 to 7 to 8 times this year. Consumers get scared. They stop spending, stop traveling. They kind of buckle down the hatches. You'll probably see down markets in equities and fixed income. Obviously bad. I don't want to end on that because, again, my base case is that we see good things this year just from COVID protocols opening up and what the market's already priced in. So that's my outlook. That's how I see it. So how have we positioned portfolios? On the equity side, we favor value versus growth for now. We've favored value for about 9 months, and that's been a really good trade for us. We favor US versus international for now, and we're always looking for tax efficient strategies. On the fixed income side, we favor short duration versus long duration because as interest rates rise, we don't want to be hit as hard. But I say for now because at some point it'll be advantageous to flip that. And then we're neutral on credit risk. We love private investments. Different opportunities exist there if that makes sense. And what would get us to shift our portfolios? Well, if we see a bottoming out in growth equities, if we see, tech has been slammed for the last month and a half, primarily because of what's going on in interest rates and because some earnings disappointed. At some point, that's going to bottom out, and I'm guessing it's going to bottom out this year, and we will flip our value tilt to growth. Right now, this is a very defensive portfolio positioning. If you were to take a look at that and say value US short duration, you'd think that I'm, calling for really bad markets. It's been a great place to be though for the last year. And but at some point that's going to flip. We won't always be defensive. We're going to take advantage of growth periods when they come. And I'm guessing there's going to be great opportunities this year just based on where markets are at. Some people get caught off sides. We are not off sides right now, but we'll be able to take advantage of pullbacks. If the 10-year treasury gets to 2.25%, 2.5%, we'll probably flip this short duration to long and take advantage of higher interest rates. And then if credit spread widen, which we're actually seeing a little bit of that happening right now, especially in the preferred space, we'll definitely take advantage of that and pick up some cheap credit to get in our portfolios. So I'm very comfortable where we're at in portfolios. There will be shifts throughout the year because I know there's going to be opportunities, but that is how we are positioned now. And I'll just kick it to Sam to wrap it up.
We're right at 50 minutes. We want to be done soon because we want to respect your time, and we really do appreciate your time. Most of you are clients. Some of you are not. We really do appreciate your time. We know with the noise that's out there, we're not perfect people. We're not perfect advisors. But we do know that our philosophy of putting our clients first and investing in our clients is it is kind of like a lighthouse on a hill, a beacon. Our clients choose us because we look out for them, and we're not trying to sell them anything. And so that's who we are, and we know we're becoming more and more few in this crazy world of noise. And I think Jeff did a great job kind of cutting through that to give you our opinion on things. So I'll show you the results of this. And
Pretty
then
split.
Go ahead.
I said it's pretty split.
Yeah. All right. So, did I? Okay, stop. Okay, sorry. There it is. I don't think I shared it. Here we go. All right. So to wrap up, Fidelis Wealth, we do all these other things. We talked a lot about investment management, but financial planning is really the core of even our investment management. Is understanding who you are and what you want to accomplish informs our investment management. So that we talk about investment management tonight kind of in a vacuum, but really it comes down to who you are and what's best for you. We also help with retirement plans for companies. We have about 10 or 11 of those, and insurance and education savings, things like that. We just want to help you make sure you're on the right path. And we have 2 CPAs in our office. We have attorneys we work with on the estate planning side. The CPAs are not employees of ours. They have their own company, but we like them a lot. So anyway, I really do appreciate your time. Why don't we wrap up and we'll close this off? And we really do appreciate your time. And we hope this is helpful. As you leave, again, there's going to be 3 short questions. Feel free to answer them. We would appreciate the feedback. Thank you all.
Thank you.
Thank you. Have a great evening. Go Rams. Oh, I said it. That's who I'm cheering for.